In this video, we're going to look at trading quotes from Paul Rotter, otherwise known as the Flipper. Stay tuned. Hey traders, a very warm welcome to you. Okay, so Paul Rotter, otherwise known as the Flipper, pretty famous day trader, scalper, very active, high volume trader, had a very specific strategy, and I think I'll do another video focusing on his strategy later, so make sure you subscribe so you get notified about that one. But anyway, he was making, rumor has it, 1 to 5 million a month day trading the German Bund, I think it was, or it might have been, I don't know, I can't remember exactly the market he was trading, but anyway, he's supposedly making a serious bit of cash. Anyway, here's some quotes from him. So if you're a day trader, this is probably quite handy for you. Okay, first one, number one, read market psychology. I constantly try to read the psychology of the market and base my decisions around it. Perfect, makes perfect sense. He's not talking here about specific chart patterns or technical patterns because he's very an order flow scalper, putting a lot of flow in the book, resting orders, pulling them in, taking them out. He is reading the psychology of the market. What does he mean by the psychology of the market? He's basically saying, listen, are we in a bullish phase? Are we bearish? Are we panicking? Is everyone chasing the upside? Is everyone chasing the downside? Is there fear? Is there fear of missing out? What is the underlying current, and how can I position in that to take some money out of it? Makes perfect sense. Great kind of tape reading, price action, attribute and skill set to have. All right, number two. As a trader, you should have no opinion. The more opinion you have, the harder it gets to get out of a losing position. This, if you've been there, you're probably nodding at the screen now, saying, yes, I've been there. I know I have been there. I'm going to hold my hands up to this one. If you're really wedded to the idea that this is the best trade ever, it's really going to work out, you're going to make loads of money out of it, it's going to go from here to here, it's going to be great, it becomes very difficult to pull the plug when it's not working because you've done so much research in it, you're so wedded to it, you think it's going to work so well, and it's so hard to say it's not working. So no opinion is great. It's a setup, it's a strategy, it's ticking a lot of boxes. There's my risk capital. Oh, it's working, great, take it out. Oh, it's not working, great, next one. No opinion makes perfect sense. All right, number three. No losing month. Where are we here? He had no losing month with the first 3 years of his trading. Later on, with bigger position sizes, I took occasional hits. We verify that? I don't know, but there's no reason for him to kind of lie about that situation, but that's pretty impressive. He did have a very specific strategy, though, which was verging on, it's a little bit dubious. It's probably on the line of being illegal now, but again, subscribe because I'm going to do a video on his specific strategy at some point in the future. So he had no losing month in his first 3 years of trading. Later on, he took a bigger position size and took occasional hits. What can we take from that? Maybe it's possible to get there and with the right strategy and the right kind of focus, have no losing month. Notice he didn't say no losing day. So losing month means that he's had some losing days, and actually he did, because we'll go down to here and later we'll talk about those. But he had the ability not to let it damage him too much and come back. We'll talk about it in a second. All right, number four. Probes the market with lots of orders. This is interesting. I hear a lot of scalpers, heavy aggressive scalpers doing this. A lot of other traders doing it as well. They have lots of orders in different markets at the same time, or he has lots of orders in different markets at the same time. Pretty close to the last traded price. The resulting trades are usually a zero-sum game, but I get a pretty good feeling for what is going on and then ultimately can make a decision for a larger trade. Interesting this. It's not my strategy as such, but I know people who do this quite a lot. They'll probe, they'll have a little play, they'll go long, they'll go short, and he's saying does it across a lot of markets. What that does is it gives you skin in the game that makes you look and see, well, actually, I haven't been filled on that one that's on the low bid. I've been filled on that one, or this and that. You start to get a picture and a pattern when you've got orders in the market as opposed to when you don't. And then his idea is, hey, I make a decision based on what's happening. So perhaps he's getting filled lots on the bid, and so he thinks, well, if this rolls, then that roll. He will make a kind of chess kind of decision of this, then that, then the other do this. And so that's pretty interesting. All right, number five. Sudden unexpected event. When some sudden unexpected event occurs, it could blow out a lot of traders even though their risk models were working just fine for a long period. We've seen that a lot of times, guys, pretty recently as well, depending on obviously when you're watching this video, but if you go back and you scroll back, you will see many times we've had really unexpected events that have caught people out, whether that's kind of big dips down in equities, whether that's kind of VIX moving into the stratosphere, whether that's interest rates moving, whether that's a currency being devalued, depegged, all this kind of stuff comes out of nowhere, and people's risk models are based on assumptions, and when these unexpected things comes out that people aren't looking for, it throws it all out, and a lot of traders are running for the door, and a lot of traders are getting hit hard. All right, and so his idea is, hey, be aware for those extreme risk events, and probably from his perspective, looks to capitalize and profit from those events. Okay, where are we now? We're at number 6, check news, then levels. So when I'll give you the quote. Before the open, I check all the economic reports that are about to be released, speeches of central bankers, simply anything that could move the market. Then I try to define important levels in the market I trade. So pretty much that's what I do, and if you're a day trader, that's probably what you should do. If you're not and you're new, welcome here. But if you're new and you're day trading, this is pretty much what you do. You look for the risk that could be present in the day. In other words, what's the economic calendar like? Are there any economic calendar like? Are there any jobs numbers coming out? Is there any economic data? Is there anything coming out of my stock that I'm trading? What about oil inventories if I'm trading oil? What about this? What about that? Having all that so you know whether you want to be flat at a certain time, you don't want to be caught out in a price spike based on news. And then going through defining the key levels that you want to get in, well, you either want to get involved in or you want to be aware of in the market you're trading. Big resistance level there, bigger one here, some support here, that kind of stuff. Jotting it down, being prepared for the day. Number 7, stop trading when you hit a daily loss. This is a really good piece of advice, okay? And he says, listen, I set daily goals for my P&L, whereas the most important thing is the stopping limit, the maximum loss I take before I switch off the screens. It's very tempting as a day trader to overrule that. You lose a certain amount of money and you think, I'll just carry on because there's a great setup here. And before you know it, you dig yourself a big hole. If there's any rule that you take away from this as a day trader, it's this: stop trading when you hit a daily loss. If you're a day trader, it's the most damaging thing you can do psychologically and for your financial well-being, if you like, on your account, is this not sticking to a daily loss. Say, hey, maximum you're prepared to lose, and when that happens, just turn those screens off and get out of there. Don't be tempted to stick around. Don't be tempted to kind of place another trade, because that loss could be magnified by 10, and it just then is just a catastrophe. So he's aware of that. You should be aware of that. Every good day trader is aware of that one. In prop firms as well, daily loss, that's it. Once you hit it, you're out the door, get out of here. Or maybe you get pushed onto a demo depending on which firm you're with. All right, number 8. Size is bigger when winning, scales back when losing. Okay, let me find this one, because this is something that a lot of really good traders do. It's something I try to do myself when I'm trading very, very well. I'll start to get a little bit more aggressive and push stuff in. And I'm looking back at historically, that's when I've done the best, is when I've been on form and I've really gone aggressive in it, and I've known when to scale back when I'm not on form. That's the key, I think, to long-term success in the game, whatever level we're talking about. Okay. It's the ability to get more aggressive in winning phases, taking bigger risks and scaling back in losing times. This is against human nature. So it's true. Human nature, this is why a lot of traders fail, I believe, and we've talked about this in previous videos. When people are trading badly, they want to double up because it means they can get out of the hole they're in quicker. I'll put more size on because I'll get back to where I was much quicker. And it's the wrong way of doing it. When you're trading badly, you need to scale back. Paul Tudor Jones does this. He scales back when he's not trading well. He takes it as a sign that he's not in tune or the strategy is not right for the market conditions. Let's dial back the risk. Let's not get too aggressive on this, because this could be damaging, long-term damaging to the account. Flip it on its head when things are going good, rather than scaling back and saying, oh great, I've made a bit of money, that's fantastic, let me protect that. No, it's being more aggressive, putting more chips on the table, more aggressive, more really pushing the throttle down while things are working, to make as much money as you can from that phase that's really in tune with your strategy and your psychology or whatever it may be. If it's working, press it. If it's not, pull back. And that's a common theme with a lot of good traders, guys. All right, quotes from Paul Rotter. 1, 2, 3, 4, 8 good quotes. If you know of any more, stick them in the comment section below. If you like this kind of stuff, give it a good old thumbs up. Thank you very much. And also don't forget to consider subscribing, because I'm going to do another video on Paul Rotter in the future. And also there's other guys on this channel as well, and me, who you might be interested in listening to. And in the day, all we're here for is to make ourselves better traders and investors. All right, guys, take care. Keep the risk managed. See you in the next one. Goodbye.